Yeah, namaskar to all my viewers and the subscribers. This is the second part of my series, in which I was covering the entire circular of Reserve Bank of India's draft guidelines for standardized approach to calculate the credit risk and capital requirements, and which is going to be effective from April 2027. And in this framework, we were discussing about the various exposure classes and how the risk weights are defined and what are the conditions to use various risk weight tables given in the circular. Right. So we will now proceed further under this circular. But before we proceed, I request you that you go and visit the previous video so that you get a continuity about what we were talking. And in this video, we are just will begin from exposures to corporates. However, we will give an overview for what we have covered in the previous video in a high level helicopter view, you can say. Friends, you know the Reserve Bank of India standardized approach for credit risk directions. This directions basically aligns with the Basel 3 framework, latest Basel 3 framework, and to calculate the risk-based capital requirements in a comparable and risk-sensitive manner. Right. So in this circular, you will get the various risk weight percentage for various asset classes, and when you get the risk weight percentage, you apply you apply this on the exposures, and you ultimately you will get risk weight assets. Okay, and when you get risk weight assets, you can easily compute the capital, because capital equal to your CRAR percentage. Okay, so this this in India is 11.5%, and this you will get from this, so you can easily multiply this and calculate the required capital under the standardized approach. So this is the basic theme of this circular. So how you will calculate the denominator here? So this circular basically talks about that. Okay, so friends, I think it is clear. Banks calculate the risk weight assets here by multiplying the exposure amount by standardized risk weight assigned to the specific exposure classes. And the fundamental principle is that risk weight must conservatively reflect the underlying credit risk. So for why the exposures are being classified into assets are classified into various exposure classes, because each exposure classes carries a different kind of risk. Okay, so this is the fundamental principle, that risk weight must conservatively reflect the underlying credit risk, and banks are over and above this, banks are mandated to carry the due diligence requirement, which we have discussed in the previous video also, that indicates a higher risk profile. And then if the internal due diligence indicates a higher risk profile, then an assigned external rating, so in that case the bank must apply a risk weight at least one bucket here. Right. So friends, in this circular we have covered various asset classes. In the previous video, we have covered exposures to sovereigns. We have seen here exposures to domestic sovereign. We have also seen selected MDBs, multilateral development banks such as the World Bank Group and the Asian Development Bank. They attract a risk weight of 0%, right? Further exposures to foreign sovereigns and foreign PSCs are risk weighted from you can see 0% to 150% based on the assessment from the international rating agencies. Right. We have also seen exposures to banks in the last video, where the framework introduces a dual mechanism for determining the risk weights on counterparty banks. We have seen external credit risk assessment approach, ECRA approach, and SCRA approach. So these all things we discussed in detail in our last video. Okay. So friends, I strongly recommend that you go and watch that video, so we'll get a better clarity. Right. So today our agenda is to cover this exposures to corporates in detail. So you will get a good idea about how this class is assigned the risk weight. Right. So friends, under the standardized approach in this draft guidelines, all the credit exposures basically are assigned risk weights either based on a specific prescribed category or according to the rating agencies, rating assigned by the eligible credit rating agencies. Okay, and the classification of these exposure into distinct exposure classes, which I've discussed above also, ensures that capital requirements are calculated in comparable and the risk sensitive manner. And within this large framework, exposures to corporates form a distinct asset class, and with the specific rules for subcategories and risk weighting, which we will see below. Right. So the first task is to define the definition of exposure class, which we are calling corporate. Okay. So how we are defining this exposure classes? So basically, the corporate exposure class encompasses of loans, bonds, receivables, and other exposures to incorporated entities, associations, partnerships, limited liability partnerships, proprietorships. It may be trust, funds, and similar entities, right? So, friends, you can say that all the exposures to corporates, that which includes loans, bonds, receivables, and it can be any incorporated entities, association, partnership, limited liability partnership, proprietorship, trust, funds, and other entities with similar characteristics. Okay, these all comes under the corporate asset classes. So there are two ways to basically two criteria to define the exposures that will fall under the corporate exposure classes. Right. First is the excluding criteria, means the financial institutions, which are not covered under the, which are not classified under the banks. Okay, which are not classified under bank class, such as you can say security firms, primary dealers, NBFCs, and insurance companies. Okay, so that financial institutions which are not specifically classified, covered under the banks class, that is included in the corporate asset class, right? So security firms, primary dealers, NBFCs, insurance companies are included under the corporate asset classes. Further, there is also criteria that domestic PSCs, and what you called as local government bodies. Okay, so these are also risk weighted in a manner similar to the corporates, right? So these are the including criteria. And what about if we talk about the excluding criteria? So it excludes the exposures to individuals, MSME, which fall under the regulatory retail criteria. So that are excluded here, as well as the exposures to corporate subordinated debt, equity, right? Subordinated debt, equity, and other capital instruments. So these are excluded from the corporate exposures, right? So this must be very clear, because if you will not classify the asset class into right category, you will not be able to apply the correct risk weight, and ultimately your capital will be capital calculation will be wrong, right? So first of all, you must be clear that what exposures we are going to call as corporate. So there are two criteria I have told you. The first one is including criteria, and second one is excluding criteria. What is including criteria? Means the FIs which are not called banks are all included here, corporates. Further, domestic PSCs and local government bodies are also included here. And under the excluding criteria, we excluded individuals, MSMEs, which are eligible for regulatory retail criteria. They are excluded. Further, the exposures to a corporate subordinated debt, equity, and capital instruments are also excluded here, right? So this is the main scope of the exposures to corporate. Now, proceeding further, the corporate exposure classes is basically defined into two subcategories, which is known as the general corporate exposures and specialized lending exposures. Right. So, what is the difference here? Basically, the general corporate exposures are risk weight primarily driven by the external ratings and the bank's own due diligence. Right. So, if a due diligence means if a bank's due diligence indicates higher risk than the external rating implies, the bank must assign a risk weight at least one bucket higher. Right. So the base risk weight for corporate claims, basically under the general corporate exposures, you can see in this table, the base risk weight varies from AAA and AA starting rating classes. It varies from 20% to 150%. Right. And there is also a table for the short-term claims, which also varies from A1 plus and A1 20%, A2 is 50%, and A3 is 100%, and so on. Right. One important point to note here in this table is that unrated class has been given a risk weight of 100%. Right. Under the long-term claims also and under the short-term claims also, unrated class has been given a rating of 100%. But friends, there are important points to note before you blindly assign a risk weight of 100%. So friends, there are strict rules which apply to unrated corporate exposures to prevent risk underestimation. Right. So what are those rules which we are, which is very important to note down? The first one and the first rule is that an unrated corporate claim can never receive a risk weight more preferential than the sovereign of its incorporation. So, in which the country it has been incorporated. So, if risk weight can never be favorable than the sovereign of its incorporation. Right. Second criteria is that there is a threshold criteria. Basically, two criteria are there. Threshold criteria. One is 200 crore threshold and one is 100 crore threshold. So, what are these criteria? So this basically assigns a panel risk weight percentage. Okay. So if a corporate or NBFCs, excluding CICs, I'm not talking about CICs here, which is core investment companies. So if a corporate or NBFCs has an aggregate exposure from the banking system of more than 200 crore, right? And all the unrated claims attract a higher risk weight of 150%. So if the banking exposures from the entire system is more than 200 crore. So if it is unrated, it should be rated. Thereby, RBI has given a penalty risk weight here because such a high exposure and you are not rated, that is not good. Okay. So in that case, you will be assigned a higher risk weight. So banks must tell the borrowers to become rated in that case. So just to encourage the borrowers and lenders to get this borrower rated. Okay. Second is 100 crore threshold. What this threshold talks about? So basically, if a corporate or NBFC has an aggregate exposure of more than 100 crore, right, and was previously rated but has subsequently become unrated. It was previously rated and has subsequently become unrated. So in that case, it attracts a penal risk weight of 150% here also. Okay. So if you have an aggregate exposure of more than 100 crore and you were rated previously and now you have become unrated, so that in that case also the risk weight will rise from 100% to 150%. Right. So friends, this not applies to CICs. It applies to corporates and NBFCs. Right. Proceeding further, we will now proceed to specialized lending exposure. So friends, what are specialized lending exposures? So specialized lending basically relates to financing where the primary source of repayment is the income generated by the asset being financed. Right. We can say that the asset which we have financed is the primary source of repayment. Okay, rather than the independent repayment capacity of the borrower. So that is why it is called specialized lending exposure. And specialized lending exposures, there are three subcategories which we call as object finance and commodities finance, and third one is project finance. Right, you can see here object finance, commodities finance, and project finance. Okay, so how these are risk weighted? So there is a condition given that if issue specific external ratings are available for these exposures, so they are risk weighted similar to the general corporate exposures which we have seen here, right? So there is no distinction in them. But if an issue specific rating is not available, then distinct risk weights apply, which you are seeing in this table likewise. Okay, so in case of objects and commodity finance, both OF and commodities finance, there is a risk weight of 100%. There is no confusion here. It is 100%. But when you comes to project finance, there are certain conditions and criteria, right? So there are basically project finance is divided into two phases. One is pre-operational phase and one is operational phase, right? So under pre-operational phase, the risk weight is 130%. Means the project has not started, it is in pre-operational phase. Therefore, the risk weight is very high. In all threes, you can see that this risk weight is very significantly high, right? Now, when the project comes under the operational phase and the risk significantly vanishes. So under operational phase also there are two main criteria. One is about the non-high quality projects, if the project belongs to a non-high quality projects, or whether the project belongs to high quality projects. So if it is a non-high quality projects, then the risk is higher as compared to high quality projects, so it is 100%. And when it comes to high quality projects, the risk is significantly lower, 80%. So you can see how the risk weight has came down from 130% to 80%. Right? Am I clear here? So you can see that the specialized lending categories, there are basically two divisions: object finance and commodities finance. These are under the same slab of 100%. But under the project finance, there are further two categories, which is pre-operational and when it is operational. Right? Pre-operational and operational. So under pre-operational, it is 130%, and under operational, it is further divided into two categories. One is non-high quality projects, and one is high quality projects. So if it is non-high quality, then it is 100%. If it is high quality, then it is 80%. Right. So it's a simple question arises here, that when a project is called high quality and when the project is called non-high quality. So friends, under this circular, the RBI has given total 9 criteria to define a high quality projects. Okay, so to qualify for the favorable 80% risk weight of as a high quality project, the project must meet stringent criteria. It must it must have completed at least 1 year of satisfactory operation, have sufficient reserve funds. Okay, so we will see one by one what are these criteria. But friends, before we see this criteria, I would like to highlight one important intersection here, which is under this point given here, that if a corporate exposure is secured by real estate, right? So it is removed from the corporate risk weight tables and instead risk weighted according to the specific criteria of the real estate exposure only. So it will not be rated under this corporate exposure if it is secured by real estate, right? And another criteria I would like to add here is about the unhedged foreign currency exposures, UFCs. Okay, so the corporate entities with unhedged foreign currency exposures may attract incremental capital requirements, right? So depending on the potential loss by EBID ratio, this can result in a 25% increase in the risk weight applied to the exposure, right? So friends, why this is? Because unhedged foreign currency exposures increases risk weights because they introduce exchange rate volatility. Okay, so if you have certain unhedged foreign currency exposures, so you are exposed to the exchange rate volatility. Okay, so that can significantly threaten a borrower's repayment capacity, right? So to account for this heightened risk, the Reserve Bank of India mandates incremental capital requirements based on the type of the borrower. We will see in section 20 later, but just to give a complete picture here. So there are corporates and MSMEs. Okay, and there are retail and residential real estate exposure. Okay, so if a corporate and MSME entity is borrowing in foreign currencies, so bank must calculate the potential loss arising from this unhedged exposure and compare it with the entity's earnings, specifically the earnings before interest and depreciation, which is EBIT. Okay, so potential loss upon EBIT. Okay, you must calculate this. And if this ratio is more than 75%, then the bank must apply 25%. This implies a 25% increase in the whatever the risk weight you are applying, you have to increase the risk weight by 25% to that exposure, right? And for retail and residential real estate exposure for individuals, basically the unhedged risk is assessed based on whether there is currency mismatch, right? So whether there are currency mismatch, you have to see it. So what does this mean? If an individual is granted a retail or residential real estate loan where the lending currency differs from the currency of their source of income, right? Lending currency in the currency which they have taken the loan, which is different. Suppose they have taken a loan in dollar and the earnings is in rupees. Okay, so there is a mismatch in the lending currency and the currency of their source of income. So in that case, a 1.5 times multiplier must be applied to the applicable risk weight, and there is a cap of 150%. So risk weight should be percent subject to maximum risk weight of 150%. Okay, so is there any criteria to avoid this panel risk weight percentage? Yeah. So this panel increases in risk weights are not applied if the exposure is adequately hedged. So if you are hedging your exposure, natural hedge or any artificial hedge, this panel increase in risk weight are not applied in that case. And covering it, but there is a condition that it must cover at least 90% of the loan installment. So 90% criteria is given that it must cover it. Okay, so that also is given in the circular that which type of hedge is considered and which type of hedge is recognized. Okay, so there are basically if I can give you a view here. So hedge is two types: natural hedge and there is financial hedge. Okay, so natural hedge occurs when a borrower has an offsetting exposure, like export revenues that has a cash flow or maturity within the same accounting year as the repayment obligations. So then in that case, the exposure is naturally hedged, right? Financial hedge means this involves using derivative contracts where the purpose and the strategy for hedging are formally documented at inception only and periodically assessed for effectiveness. Okay, so uh, in that case, this is called the financial hedge. Okay, so the friend's question here is how to calculate this potential loss. So this framework not specifically give any methodology here, but I think the calculation must be done according to the instruction contained in RBI UFSC Unhedged Foreign Currency Exposure Directions 2022. While the exact calculation for the loss is not provided here, bank must calculate it, and it is basically given in that direction. So you can check it there, right? And what about the EBIT here? So EBIT basically means profit after tax plus depreciation plus interest on debt or plus lease rentals if any. So these all comes out to EBIT. Okay. So if this ratio, as I already told, will be the major ratio which will decide whether incremental risk weights are applied or not applied. Right. So friends, similarly, this 1.5 times multiplier, this 1.5 times multiplier does not blindly applies to all unhedged retail and residential real estate exposures to individuals. So this applies only when where the borrower lending currency differs from the currency of the borrower's source of income. Okay, so when this currency mismatch exists, the bank must apply the 1.5 times multiplier to the applicable risk weight, but the resulting risk weight is subject to a maximum cap of 150%. Okay, so avoid this penalty, the exposure must be sufficiently protected by the natural hedge, or there can be a financial hedge, and that covers at least 90% of the loan installment. Right. So a bank must identify this hedge is actually effective or not. It will check the coverage amount. Okay. So it will check whether it is documented at inception if it is a financial uh, hedge, and whether the periodic assessment has been done and effectiveness has been checked at periodic intervals or not, and accounting standard guidelines has been followed or not issued by ICAAP. So these are the conditions to check whether this hedge is okay. So friends, let's proceed further, because I think I've sufficiently explained this part about the spatial convenience here, which the RBI has mentioned. Okay, so friends, coming back to our project finance, we were talking about the criteria for defining a high quality projects. Okay, so coming to criteria number one, as you can see, there are 9 total criteria given here. So criteria number one talks about the proven track record, right? Proven track records. So what does this mean? So if the infrastructure project must have successfully completed at least 1 year of satisfactory operations following its date of completion of commercial operation, which you know as it is called DCCO. So if this period has lapsed and it is satisfactory, so then this criteria is fulfilled, and it is assumed that the infrastructure project has a proven track record. Okay. Second is about the restrictions on the borrower, restrictions on borrower, right? So there must be a suitable covenants in place that prevent the borrower entity from taking actions detrimental to creditors, such as being barred from issuing additional debt without the existing creditors' consent. So just to put a restriction on the borrower, that borrower behave in a financial disciplined way. If this exists, so then this criteria is fulfilled, right? Coming to third criteria is about maintaining the financial buffers. Financial buffers. So what does this mean? So the borrower must maintain sufficient reserve funds or other financial arrangements specifically to cover the you can say contingency funding and working capital requirements. So if this arrangement is there, this criteria is fulfilled, right? Coming to fourth criteria, this criteria is basically talking about the protected revenue streams. Okay, so what does this mean, protected revenue streams? So basically the project revenues must be it is technical word here, availability based. Okay, I will discuss later on what does this mean. Availability based and subject to a rate of return regulation. Okay, or take or pay contract. Okay, so for example, there can be a legally enforceable and irrevocable annuities under a build, operate, transfer BOT model, which you can say BOT model, where the project sponsors are compensated even if traffic levels fall short, right? So if this is there, then this criteria is fulfilled. The fifth point is about the borrower's revenue. So their condition is that there must be a high quality counterparty. High quality counterparty. Okay. So the borrower's revenue must primarily depend on one main counterparty, and that is inherently low risk. Basically, it can be a central government, a public sector entity, or a corporate entity carrying a risk weight of 80% or lower, because you are claiming for 80% risk weight. So your counterparty must have at least a lower risk weight than 80% or maximum 80%, right? So if this arrangement is there, then this fifth condition is also satisfied. Now, sixth condition is about the legal and structural protections. So, friends, the contract must provide a high degree of protection to creditors in the event of default, right? So, there should be a mechanism like the escrow of cash flows and establishing a legal first claim on for the lending bank. So, this kind of arrangement, if there is available, then these conditions are satisfied. Okay. Now, coming to last three conditions. The seventh condition is about the termination procedure. I have named it termination. Okay. So, what does this mean? So, in the event that the project is terminated, the main counterparty must explicitly protect the creditors from resulting losses. Right. So, there should be a clause like this. termination protection clause. Okay. Now moving further to the seventh point, all assets, contracts and assets necessary to operate the project must be fully charged in favor of the creditors to the maximum extent permitted by the applicable law. So this conditions talks about the collateralization of assets. Okay. And lastly, step-in rights are there. You can say it. The lending creditor must legally have the ability to assume control of the borrower's entity in the case of default. So there should be an step-in rights. So friends, you are seeing these 9 criteria about the project finance. So what are these 9 criteria? There must be a proven track record. Second condition is there should be restriction on the borrower. The borrower cannot take any action which is detrimental to the creditors. Okay, there should be suitable confidence regarding this. Third one is for maintaining sufficient reserve funds. Fourth one is protected revenue streams. Okay. Fifth one is that that should be at least one main counterparty, and that counterparty must be of lower risk. Okay, that you can call as high quality counterparty. Sixth one is about the legal and structural protection in case of borrower's entity defaulting. Okay, and the seventh condition is there should be a termination protection where the main counterparty will protect the creditors from the losses resulting from the termination of the project. Okay, so and the seventh one is that all assets and contracts should be collateralized and should be marked in favor, charged in favor of the creditors. And the last condition is about the step-in rights, which the lending creditors must legally have the ability to assume control of the borrower's entity in case the borrower defaults. Right. So friends, these are the conditions. So if these conditions are met, you can claim for a lower risk weight percentage of 80%. Otherwise, your risk weight will under the operational phase will be 100%. I think it's clear, friends. Now there are key technical words here. Okay. So friends, I will explain this 3 technical words here, which I have mentioned above. So what does this mean? Availability based revenues. Availability based revenues. Okay. So friends, basically availability based revenues means that a project earns money simply by being built and ready for use. Okay. It earns money simply by being built and ready for use. So once construction is finished, the project company receives payments from its counterparty, such as government, as long as it fulfills the condition of its contract. Okay, so in simple terms, means the project owners get paid for making the facility available, regardless of how much the public actually uses it. Okay, I will repeat, the project owners get paid for making the facility available, regardless of how much the public actually uses it. For example, in certain highway projects, the government might guarantee a fixed payment to the builder, even if the traffic falls short of expectations. Right. So in that case, government will pay. It will not say that the public will use it or how much traffic is there on the road. It will not depend on this. There is a certain amount. The government guarantees a fixed payment to the builder even if the traffic falls short of expectation. So this is meaning of the availability based revenue. So if you have made available something, then you are and it is ready for use, you will get the payment. You will earn the revenue. Right. I think it is clear. Second is rate of return regulation. What does this mean? So basically, this is a method used to control prices. Okay, usually for public utilities like water or electricity. So under this system, the government or a regulatory authority sets the fair price that the utility company is allowed to charge its customer. Okay, so if I explain in the simple language, the government caps the price at a level that covers the company's operating cost and allows them to make a specific predetermined profit margin, their rate of return. Okay, so but prevents them from overcharging the public. So it's basically is a price form of price setting regulation. Okay, where the government and authority determines the fair price allowed to charge by the public entity, right? And the third one is take or pay contracts. So what are take or pay contracts? So basically, these are the basically agreements between a buyer and a seller that guarantee the seller will generate a predictable income. Okay, so the contract forces the buyer to either take a specific pre-agreed amount of goods or services at a set price or pay a penalty if they decide not to buy them. Right. So in simple terms, basically the buyer is essentially saying, that I will buy this exact amount from you. Okay. And if I end up not needing it, I will pay you a fine anyway. Right. I will buy exact amount from you. And if I end up not needing it, I will pay you a fine anyway. Okay, so this setup, what it does, so this setup basically ensures that the financial risk is shared between the supplier and the buyer. Okay, I think it is clear. And friends, a question arises here that whether there are any limits on which the entities use, take or pay contracts. So as per this circular, there is no general restrictions on which entities can enter into take or pay contracts in the broader market, and as they are simply defined as the agreements between any buyer and a seller. Okay. However, in the specific context of this circular, this framework, there are strict limits on the counterparty. If a bank wants to use that take or pay contract to classify a project finance as a high quality project which benefits from a preferential 80% risk weight. Okay, so for a project utilizing a take or pay contract to qualify as high quality, the borrower's revenue must primarily depend on one main counterparty, and that counterparty is strictly limited to being a central government, a PSC, and a corporate entity that carries the risk weight of 80% or lower. Okay, so this, friends, is all about the uh, corporate exposure classes. So I think I have covered this in bit detail. So just a quick overview before I end this video, because I will not able to cover the next exposure classes in this video because it's becoming too long. I will come up with the next exposure classes in my next video series. Okay, now before I close this video, I would like to summarize the key points. So we have seen exposures to corporate. So we have seen what is the scope and what are entities which are covered under this corporate asset classes, right? And we have seen the two categories here. One is general corporate, one is specialized lending, right? We have seen general corporate exposures are risk weighted from 20% to starting from 20% to going to 150% below double B rating. And we have seen unrated corporate exposures generally which receive a risk weight of 100% ideally, but this escalates to panel 150% risk weight for large unrated exposures, means where the aggregate banking system exposures exceeds 200 crore, or for corporate that were previously rated but subsequently become unrated. So and where the exposure exceeds 100 crore. Okay, then we have seen the specialized lending exposures. This is a subcategory covering a project, object, or commodity finance and is risk weighted at 100% to 130% during the pre-operational phase, or you can say for non-high quality projects. But for high quality project finance, that is in the operational phase, benefits from a preferential 80% risk weight. Right. Uh, I think we have covered sufficiently. And in the next video, I will come up with exposures to subordinated debt, equity, and capital instruments. And then we will move on to the retail exposures and MSME exposures. Right? Retail exposures and MSME exposures. Okay, friends. I think you have gained something from this video. Do like and subscribe if you like the explanation, and that keeps me motivated. And thank you, friends, for watching till end. Thank you very much.